A very good afternoon, good morning. Welcome to FX Week Ahead live market analysis with myself, Giles Coughlin, Chief Currency Analyst. Very good to have you here. Particularly welcome if this is your first time. Hello, Jabin, Manujah, Mohammed, Mohsen. Good to have you all on board. Just going to give folks 30 seconds or so as we sign in. Please do make sure that you put any comments or questions you have in the Q&A question box, which is on the GoToWebinar control panel. Also, please do use the chat feature as well. That will be great if you want to be using that. And please let me know if you can hear me and see my screens okay. That's always appreciated to know that I'm coming through loud and clear. Looking forward to getting us stuck in today and making clear what's happening with markets. Remember that the whole idea of these look ahead webinars is that we can see exactly what the major risks are as we approach the trading week and the major opportunities. Please do remember that the idea of this webinar is that you look over my shoulder, someone with a professional trading background, a professional analyst. You see how I go about analyzing the markets, and then that helps you with your analysis. And over time, you start to pick up a few tips and tricks that I've learned along the way. These are the main issues we're going to be looking at. We're going to be looking at what's driving gold prices, dollar, how to trade the US CPI print. That'll be very interesting this week. We're looking at the inflation factor that markets are fearing. Is also looking at the Australian dollar. There is a lot of heavily sold positions on the Aussie. We'll be checking out that, as well as looking at the main drivers in the US dollar, and look at where's next for Euro US dollar and global stocks. So there is plenty to be looking at today. So without further ado, I just want to give us a quick overview on the markets. I'm going to go over to my charts, and over at the charts we should see what's going on. Let's just have a little look there. There we go. So looking over at the charts, you can see here what's going on now. Let's have a look. Now, as we start the session, please note that the dollar yen is seeing some strong upside. Now, the reason for the strong upside in the dollar yen is as follows. There is expectations that the US Federal Reserve will be announcing bond tapering at the November meeting. There are also expectations that that bond tapering will be finishing by the middle of next year. So as a consequence, what we should be looking for is further upside in the dollar yen and buyers on dips, as long as that narrative remains. So one key market you want to look at is the US 10-year yields. Now, as US 10-year yields drive higher, that's what's been driving the dollar yen higher. So that break to the upside on the hawkish shift from the Federal Reserve has resulted in the dollar yen just moving up into this key overhead resistance level. Now, if anyone was long dollar yen, this is the first area to look at taking profit. So I do have a long dollar yen position on, and I'll be looking at taking profit up into that overhead resistance. So when you're trading the dollar yen, you always want to keep a careful eye on what the US 10-year yields are doing. You'll notice how closely US 10-year yields and the US dollar Japanese yen track each other. So the rise higher in yields is resulting in that strong surge higher in the dollar yen, and that strong surge higher in the dollar yen is all on those expectations of Fed tapering in November and inflationary fears, all helping dollar yen higher. Also, there was some relief that the Japanese government is not going to be increasing capital gains tax. So we've seen some relief and strength in the yen crosses on that news that broke out overnight. So the dollar itself is fairly flat. So you can see that this move higher in the dollar yen is mainly a yen-driven trade. Now, one currency pair that I was looking at trading last week was the pound yen, and we'll just go through that and this was a trade that I was looking at on Friday, just looking at the pound yen breaking out of that key trend line. So you see that key trend line on the daily chart broken through. Now the Bank of England are expected to hike interest rates to control rising inflation. That's been boosting the pound, the yen weakness, and the pound strength. It just meant the pound as yen pair soared through 152 and 153. Next stop up to that 155, 156 region, which is my ultimate take profit target for my pound yen. So at the moment, any retracements lower of that 152 region remains suitable for buying as long as expectations are in place that the Bank of England is be raising interest rates. If you just take a look at the SONIA futures markets, I'll show you what's happening. The SONIA future markets are moving significantly lower, which is indicative of coming interest rate hikes. So you can see here, look how fast those SONIA futures are moving lower. Futures traders are just expecting higher interest rates to come from the Bank of England. Now the problem is will rising interest rates be able to control rising inflation? Well, yes, if the rising inflation was due to normal factors, but at the moment the rising inflation is due to supply issues. So if the Bank of England hike interest rates, they risk slowing the UK economy and sending the UK into a recession. So whether that carries on, we may need to keep looking at those factors. In the very near term, upside in the pound remains the reality that there could easily be some upside in the pound on expectations that the Bank of England will hike interest rates. And there were two comments out on the weekend, one by Bank of England's Governor Bailey, who said he's concerned about inflation, and one about Bank of England Saunders, who said that markets are right to be pricing in higher interest rates. So all of that has helped boost the pounds this week. So we have got some pound upside, but notice that a lot of the pound upside is from pound yen. Pound US dollar is pretty much flat. So that tells us that a lot of the pound yen upside is on this yen weakness. So just be very aware of that, that there is a big narrative going on around the pound. Now, one pair that is very interesting, and I'll explain to you, and I'll show you a little trick, is the euro pound. Now, I've been looking at the euro pound pair as a potential short, and I do like that. Now, if you just look, if we just take this off, if you look at the euro pound, you can see euro pound is testing that trend line to the downside. Now, the ECB are expected to keep interest rates on hold. The Bank of England is expected to increase interest rates. Now, one way of seeing visually what's expected to take place between the central banks is look at what's called the bond yield spread. Now, on this chart, I have the German 10-year bond, and I minus from the German 10-year bond the UK 10-year gilt. And that's the bond yield spread between Germany and the UK. So you might say, well, why do we use Germany? It's because there isn't a euro bond. Germany is the largest member of the European Union. So the German Bund is used as a proxy for a European bond, if you like. Now, when you put those two, do you see how when the bond yield spread rises and when it falls, the euro pound tends to track it? So what a bond yield spread is, it's a really good proxy for the overall movement that's anticipated in currency markets. So you can see it doesn't always work. So when the bond yield spread's moving higher here in April 2006, euro pound was pretty flat. But generally you can see how the movements in the euro pound is tracked by the bond yield spread. Now at the moment, we've just had the bond yield spread surge very significantly lower, breaking those lows. So I'm expecting the euro pound to move lower in sympathy with the bond yield spread. And the outlook remains the same, that the ECB should be more on holding interest rates, whereas the UK is expected to raise interest rates. So you'd expect the euro pound to fall. So looking at that bond yield spread, how we'd look at this As long as that situation remains the same, the euro pound is a sell. Now, selling at this point is not the best place. I have sold at this point, but a better area to be selling would be that 0.520 region, a little retracement, or a short, sharp, clean break of that trend line. So if that trend line breaks sharply to the downside, that could be good. Now, there is some risks with this. Number one risk is the fact that the Northern Ireland Protocol has been renegotiated this week. The UK is seeking some different agenda and a different terms within the Northern Ireland Protocol. The European Union is expecting to negotiate with the EU, with the UK, but whether those negotiations go well or badly will impact the pound. So if the negotiations get agreed, expect the pound to strengthen, euro pound to fall. But if they don't get agreed, say PM Johnson decides to really be antagonistic towards the European Union, a very worst case scenario, the Brexit negotiations get reopened. So we need to be careful of that risk for the euro pound. But that bond yield spread is signaling a move lower in the euro pound. So you can see it doesn't always work. So you can see here on the euro pound, here's moving lower. You know, the euro pound is still moving higher, but eventually the price will move in tandem with the bond yield spread. And at the moment, we're seeing the bond yield spread move sharply lower. So we anticipate euro pound to move lower on a swing trading basis. So that's one to look out for. Now, gold is a very interesting market at the moment. We'll just take a look at what's happening with gold. Just going to move across my screens. Now, I did a very interesting article here today that is on my blog. And let's just see if I've got that on. Let's see if I've got that here. Yeah, and it says there's 4 things to know about trading gold. So if you haven't read this article, make sure you do. I'm just going to take us through it. Man, I'm just gonna take you through what's happening with gold, okay? So the 4 things you look at gold is real yields, the US dollar, seasonal demand, and ETF levels. At the moment, the dollar and real yields is really what's pushing gold around. Now, just take a look here and I'll show you what happens. If you look here, what you can see is that real yields, when they push higher alongside the dollar, you see gold move lower. So at the moment, that push higher in real yields in the dollar has been pushing gold lower. So if real yields keep rising and the dollar keeps rising, expect gold to fall, right? If real yields keep rising and the dollar keeps falling, expect gold to fall. That's the number one thing to be thinking of. Now, inflation expectations are impacting real yield. So if inflation expectations keep rising, and if inflation expectations are rising faster than 10-year yields are rising, then in that scenario, with yields moving higher, but inflation moving higher more quickly, then real yields would fall. And that would be upside in gold. So you have to keep an eye on the real yields, what they're doing. Now, what's happening with the dollar at the moment is gold is tricky because the dollar is quite flat. Now, the dollar, remember the dollar smile theory that I shared with you? Now, that dollar smile theory is here. The dollar appreciates when the US economy is doing well or when there's a fear in the market. The US dollar is weak when the rest of the world is growing more quickly. So with the rest of the world expected to raise interest rates, potentially more quickly on inflation fears, this could pressure the dollar. So all of that means that gold has a little bit of sideways to downward action in it at the moment. Now you saw this strong upside on Friday. That was on that NFP miss. So the dollar weakened, but then traders looked at this. Look at my Twitter account. I went through this in some detail. So if you're not following me on Twitter, please do. You can go through all the videos. I did a number of different videos on Friday, taking us through all that. If you look at gold, you can see that there's significant rejection. You see that candle? That's a bullish, that's a bearish reversal candle. Now, what this is signaling is it's signaling lower prices technically, but whether they happen or not, we'll have to see, because this support level around that 1750 is key. See, it's support, and we may find some buyers stepping back in at the 1750. Now, we need to be looking at what's happening with real yields and the dollar to understand what's happening with gold. At the moment, as long as the Fed's expected to taper, and if real yields start pushing higher, if inflation expectations fall, then expect gold to move to the downside. So this is what you need to look for gold. Now, on Wednesday, we had the CPI data print. And the CPI data print is expecting 0.3% month on month, 0.2% month on month for the core reading. This is the major reading for the Fed. The Fed prefers the month on month reading, the core CPI rather. So the Fed prefers the core reading. Now, if we get that core reading, and if that core reading comes in, say, above 0.5, 0.6%, then we might see real yields push lower. And if real yields potentially push lower, we expect gold upside. But it's hard at the moment, because if the dollar rises sharply higher, that's a negative for gold. So if CPI inflation is high, we could see some choppy action. If it's high, then the Fed will be expected to taper more quickly, raise interest rates more quickly. That's dollar strength, and that's weakness in the dollar. But if the inflation is high, we could see investors think, well, this is going to be bad news, because the Fed won't be able to raise interest rates too quickly, and we could see some upside in gold. Gold is quite hard to trade right now because there's so many different factors going in from it. So the best thing you can do is go away and look at real yields, look at the US dollar, understand how this impacts gold, and these are the two major drivers at the moment. So just keep your eye on the CPI data. So if the CPI data is a big miss, so say it comes in like much lower than expected, then we could see some sharp downside in gold. It's a tricky one to trade, this one, as I'm talking about it out loud, because of the different drivers of the dollar and the strange market conditions we have at the moment, particularly with the 10-year yields moving higher. So looking at 10-year yield, you see the way that yields, I'll explain this, you see the way that bond yields are moving a lot higher. Now, this is moving higher for bad reasons. It's inflation fears. The market's concerned that high inflation is going to get central banks to raise interest rates quickly. Now if those yields rise too quickly, then stocks could be moving sharply lower. Now, the chart to look at for stocks is the VIX, it's a volatility index. If the volatility index, and this is the number of options that are being exercised for the S&P 500, and basically this VIX reading rises when investors are scared and they're hedging their longs. So when this rises, you typically see stocks falling. So let me show you, if I just put onto this chart the S&P 500. You'll see here, look, as the VIX rises, US stocks fall. Rising VIX, falling stocks. Rising VIX, falling stocks. Falling VIX, rising stocks. So use the VIX as a proxy for risk. If the VIX rises higher and closes above that 21 level, expect more downside in stocks. If the VIX manages to stay beneath that 20 and moves down to that 18 region, expect upside in the stock market. Falling VIX, rising stocks, rising VIX, falling stocks. So just be aware of that dynamic that's going on at the moment. FTSE 100, a very interesting place. Just look here, if we see the FTSE 100 breaking above this level, then that does open up movements back up towards that 7,500 region. Ultimately, I would expect and like to see a retest of that 7,500 region. So just keep an eye on this. If we get a break and close above that level, as long as the market stays above, you can stay with it. If the market pulls back below, you can cancel the trade. So it's a place to have a relatively small, well-defined risk with a good potential reward. So that 7,500 region would be the ultimate target, back up to those pre-COVID-19 highs. FTSE 100 is the only major stock market that hasn't had its COVID highs filled. All the other major stock markets here have. So there's definitely potential upside for the FTSE 100. Another market that's really worth looking at the moment is the Australian dollar. Now, these are the two markets you really need to have a look on with the Australian dollar. The iron ore and coal market. Iron ore is the light orange, coal market is the strong orange. Now, coal's been rising, but iron ore prices have been falling. Australia exports about 20–25% of their entire economy comes from iron ore exports. So when iron ore exports are falling, the Australian country is essentially having a pay cut. When iron ore prices rise, that's a boost for the Australian dollar. This fall in iron ore prices has been negative for the Australian dollar. Now we're seeing those iron ore prices pick up. Now coal prices, Australia exports about 16% of their entire GDP comes from coal exports. So if we get iron ore and coal exports both moving higher together, expect that to boost the Australian dollar. Now today we've seen a lot of strong upside in the Aussie yen, which is kind of what you'd expect with those yen crosses being so weak. Now just have a look here. Look at that. Look at that surge higher in the Aussie yen. So just be aware that if iron ore prices keep moving higher, then this could be a great area to enter. Any retracements back down to this broken trend line around the 82 region. So look out for that. If we keep getting iron ore prices moving to the upside, that's a strong upside break, ultimate target up to that 85 region. Stay above, stay with it, get back below, you can look to exit the trade. So that Australian dollar yen is a very interesting trade. New Zealand dollar yen also pushing to the upside as well. CAD yen pushing up with oil prices moving so high. Now, oil prices are a fascinating point. Look, oil prices pushed and broke above 77 last week. That is a key resistance level. That is now support. Now, oil's moving higher for three reasons. One, inventory levels are falling. Two, COVID-19 cases are falling and vaccination levels are rising. Three, OPEC is very good at handling market communication to boost prices. So the medium-term upside scenario for oil remains. Now, looking at how to get into this market, it's not worth chasing at these highs. Instead, any retracement back down to this 77 region is ideal for going long. So if we see any retracements back down to this level here, just 77, just above, expect buyers. Now that is a retest of that broken resistance. It's also this trend line here. And some analysts are talking about oil moving back up to $100. Now I think that's not unreasonable. $100 is just up here, the $90 and $100 region. We could easily see a wider move back up there. So look out for upside in oil over the coming few weeks. Now, let's look at the euro-US dollar pair. Now, whenever you're trading the euro-US dollar pair, there's only one currency you need to be aware of, and that's the dollar. Now, if you look here at the dollar index, let me just put this in place for you. See the dollar index? Sorry, look, I meant to do that as an overlay. All right, now, whenever you're trading the euro US dollar, all you need to do is look at the dollar index. I'll just put the Dixie on. Now, dollar index is sometimes nicknamed the anti-euro US dollar. So whenever the dollar rises, the euro US dollar falls. Whenever the dollar rises, the euro US dollar falls. Whenever the dollar falls, the euro US dollar rises. So at the moment, we've got a rising dollar, so a falling euro US dollar. So if you invert the dollar index scale, you'll see, look, if you're trading the euro US dollar, you could equally be trading the dollar index. They move exactly opposite to each other. Now, the reason they do that is because the dollar index has a very heavy euro weighting. About 60% of the dollar index is weighted against the euro. So whatever the euro is not doing, the dollar is doing. So a key factor to be aware of with the euro US dollar is just ask yourself, well, what's the dollar going to do? And at the moment, it's murky, because there's one part of the situation that said the dollar should rise on the Fed taper hopes. But there's another part that said the dollar should sink as the rest of the world grows more quickly than the US on these inflation fears. So which narrative will win out? We have to see. If one narrative becomes more obvious than the other, that's when the opportunity is. So if all of a sudden we suddenly saw the dollar strengthening on something like risk-off trading, expect immediate euro-US downside. But if the rest of the world looks like it's growing faster than the US, and the US economic recovery is called into question, say there's a disappointing dip in CPI data, then you expect dollar weakness and expect euro-US dollar upside. So keep an eye on that. But the dollar quite flat today. The strength we're seeing in the dollar is really the yen weakness against the US dollar Japanese yen. So I hope that makes sense. Let's just see what other major markets are going on. Yeah, don't forget that real yields in the dollar. If you're trading gold, Manu, does that make sense for you? If you're trading gold, that you need to see what's happening with the real. You need to see what's happening here with the real yield. Let me just. You need to see what's happening here with the real yields. So as real yields fall and when real yields fall and the dollar falls, that's when you get gold upside. Okay, so let's just get rid of this. Yeah, we'll just get rid of that for a minute. When real yields fall, the dollar falls, gold goes heavily up. But when real yields rises and the dollar rises, that's when gold goes down. Now at the moment, real yields and the dollar are moving higher, okay, and that's pressurizing the gold lower. But if all real yields is US 10 years minus inflation expectations. So Manu, you want to keep your eyes on this. Now the tip is a inflation gauge which is roughly proximate to real yields. Now the trading view symbol is this strategy, is this symbol here, Amex tip, right? So use that as a proxy for real yields, and you can see the two roughly correlate with each other. Now real yields only update once a day, whereas tips will trade day to day. So you got to keep your eyes on inflation expectations, because that really drives real yields. So if we start to see real yields surge higher and the dollar surge higher, expect more gold downside. And remember, we've got this quite bearish technical picture for gold with this bearish reversal hammer bar in place. But 1750 is absolutely major support here. So this is going into a major support level, and typically when you have selling into these support levels, you know, all bets are off because traders will reconsider what to do. These support and resistance levels are just deciding points in the market when traders think, do I really want to go through this or not? And just need to see a clear picture for gold, and that's likely to come from the CPI data middle of the week. Now, FOMC meeting minutes will also be eyed carefully. You know, are there any hints about Fed tapering, speed of tapering? Anything that results in a faster tapering should result in 10-year yields moving higher, real yields moving higher. So anything that's towards faster tapering, dollar strength, gold downside, you know, stocks should be downside, US 10-year yield downside. US 10-year yield upside rather, gold downside. If it's slow and there's anything negative out of the minutes, then expect that to be dollar weakness and gold upside. We've got Australian data on the Thursday. This will be important. If we see a really good jobs number here, I'd expect that to boost the Aussie. Aussie so heavily sold at the moment. It's at record sold levels. So it's ready for a retracement. It's not that it's bullish, but if there is a good employment data here, and we get iron ore prices rising, and copper, and coal prices, all that gives plenty of optimism. PPI data will be looked at for the US. That is producer price index. Basically, that tells us what prices producers are paying. Expect that to be rising because of inflation. And if that is rising and inflation is getting higher, then look out for that that impact. And it's a nuanced impact because it could go one of either way. If the inflation is higher, could result in dollar strength on expected interest rate hikes, but it could also result in the sort of nervousness around rising interest rates. That could result in dollar strength on a risk-off trading. So inflation will be carefully viewed, particularly the PPI. Retail sales out of the US on Friday. Again, anything strong for the US economy should result in dollar strength, 10-year yields upside, dollar yen upside. So it will be an important week for the dollar. This is the most important event of the week, the CPI data, and also the Australian data will be very important. Strong reading there, that would be good upside for the Aussie. The only thing to remember is China is also very influential for the Australian dollar. So any significant news for China will also impact the Aussie dollar. What's good for China is good for the Australian dollar. 80% of China's trade comes from its trade with China. So if China's growing, then Aussie will be lifted by China's growth. If China's weak, then expect Australia to have weakness too. So, you know, a lot of interrelated factors this week. There is a number of risks that we have in the market. So the Evergrande risk, the Brexit risk. Is there the fact that yields are rising higher so quickly? Is that because that's because investors are expecting central banks to raise interest rates to control inflation? That could slow growth, so we could have a stagflationary environment. You don't know what a stagflation environment is. I was working today as an analyst for Forex Live, and I did a very helpful post on what various inflationary scenarios look like. So do have a look at that, and I've done a nice little chart to help you understand the different inflationary environments that there are out there. Okay. Okay, folks. I hope that's been a help, just getting us ready for the week ahead. And if you've got any questions, please don't hesitate to ask them now. Otherwise, we will be back on Wednesday and we'll look at, get ready for that US CPI data. Yeah, thanks, Jabin. Yeah, Manu's asking what will happen to gold. Again, it's going to be, I expect it to be flat and sideways until Wednesday. That's what I'm expecting. Unless 10-year yields really rip higher, even further, then eventually you'd expect those real yields to move higher. So if real yields move higher and the dollar moves higher, so if dollar moves out higher above that 94.50 region and 10-year yields keep moving higher, then I expect gold downside to break through that 1750. So the way I play gold is if real yields and the dollar move higher, expect gold to move down and then look for a retest and then looking at a profit take at 1728. Now, at the moment, gold's sideways. Now, heading into the US CPI print, what I'd expect is any retrace of 1770 to find sellers at a first test. But I wouldn't be trading this because I want to see a clear direction from the dollar and the 10-year yields, Manu. I really want to see that. And at the moment, look, have we got clarity on it? And the answer is no. Because 10-year yields, what are they doing? Yes, they're moving to the upside, but inflation expectations, they're rising as well. So real yields are still sort of sideways. Certainly from last week, we have to wait for this fresh day to see what's happening. What's the dollar doing? It's sideways. And gold at the moment is sideways. So I want to see a clear driver. So if I get a clear driver, in the dollar and real yields, and if they clearly move higher, I expect more gold downside. They're flat at the moment. They're waiting for the next turn direction. Now, if they suddenly sink sharply lower, I expect gold upside. So gold at the moment is flat. There isn't a clear direction on it. We need to wait. Manu, I hope that helps. Yes, good. I'm glad that helps. Just learn from this. You just need to see this. Like, you can see the way that, you know, if you suddenly have an environment where you're expecting real yields to move higher and the dollar to move higher, do you see how gold tracks lower? We want to get that next near-term direction. We've had the last direction, which is dollar strength and real yields higher. And that's played out. We saw that gold downside. Now we've got this flat action. We're waiting for the new direction, and that's like to come on a new catalyst. Yeah, you can see that perfect, right? You've got it, right? If you've got that narrative, you are like, you know, 95% of the way ahead of most other traders. If you can see that, yeah, I will wait. Good. That's what I'm doing, and I'm going to wait. Look, come back on Wednesday, and I'll get us totally ready. Okay. We'll look at the CPI data, and I'll show us exactly what I'll say. Exactly what I'm going to do. So when we had that NFP miss, I traded long gold because I was expecting dollar weakness and the US 10-year yields to move low. Now they did. I traded 3 positions long gold, and I took profit up at these levels here. Now I didn't carry on with the long because I thought it's not going to change the Fed's mind. So at the moment, we need something to change the Fed's mind for gold to be a really decent long. Yeah, yeah, that's it. Come back on Wednesday. I'll get everyone sorted. Folks, been a pleasure as always. You take care, and I look forward to speaking to you soon. Thanks now. Goodbye.